The IRS has been quietly taxing up to 85% of Social Security benefits for decades. Most people collecting it right now have no idea this is happening. And the formula that triggers it was written in 1983 and has never once been adjusted for inflation. That last detail is the one that changes everything. I am going to explain exactly how this formula works, which income sources trigger it, why the thresholds have stayed frozen for over 40 years, and what tens of millions of retirees can still do before it is too late to act. Social Security was sold to the American public for 4 decades as a retirement benefit. The payroll taxes came out of every paycheck. The program was framed as a savings mechanism, contributions going in, benefits coming out later, and those benefits being your money returned to you. For most of the program's history, Social Security benefits were not taxed at the federal level at all. You paid in, you collected. The government did not take a cut on the way out. That changed in 1983. Congress passed an amendment to the Social Security Act as part of a larger reform package. The commission that recommended the change was led by Alan Greenspan, who would later become chairman of the Federal Reserve. The argument was simple. The Social Security Trust Fund was running out of money. Congress needed new revenue without raising payroll taxes directly. The solution was to tax a portion of benefits for higher income retirees. The IRS was authorized to include Social Security income in taxable income for households above specific thresholds. At the time, the thresholds were set at $25,000 per year for single filers and $32,000 for married couples filing jointly. According to the congressional record, the intent was to affect only the top 10% of Social Security recipients, people with significant outside income, retirees with large pensions or investment portfolios, not the average worker who spent their career paying in and expected to collect in full. Congress set those thresholds in 1983, then they never touched them again. No inflation adjustment, no cost of living provision, no automatic update tied to wage growth or benefit levels. For 43 years, the cutoffs have sat exactly where a commission set them, when a gallon of gas cost $1.11 and the average Social Security benefit was less than $500 per month. Here is what that decision has done over time. When the 1983 thresholds were written, roughly 10% of Social Security recipients owed any federal tax on their benefits. That was the stated target. Today, the Social Security Administration estimates that more than 50% of recipients pay federal tax on some portion of their Social Security. More than half. The thresholds did not move. Everyone else did. Wages rose, benefit levels rose, retirement account balances grew, and every year a larger share of retirees crossed a line that was designed to catch a small minority. Congress did not pass a law raising taxes on Social Security. The inflation did it automatically, silently, without a single vote. Now let me explain how the formula actually works, because this is the part most financial articles get wrong by oversimplifying it. The IRS does not look at your ordinary taxable income to determine how much of your Social Security gets taxed. They use a separate calculation called combined income, sometimes called provisional income. Combined income adds three things together. First, your adjusted gross income, which includes wages, retirement account distributions, pension payments, rental income, and capital gains. Second, any tax-exempt interest you received during the year, typically from municipal bonds. Third, 50% of your total Social Security benefit for the year. That combined income total is then measured against two thresholds. The first threshold for a single filer is $25,000. Below that, none of your Social Security is taxed. Between $25,000 and $34,000 in combined income, up to 50% of your Social Security benefit is included in taxable income. Above $34,000 in combined income, up to 85% of your Social Security benefit is included in taxable income. For married couples filing jointly, the thresholds are $32,000 and $44,000. Notice the numbers. For a single filer, the 85% bracket starts at $34,000 of combined income. In 1983, that was considered substantial retirement income. In 2026, the average Social Security benefit for a retired worker is roughly $22,000 per year. Add just $12,000 from any other source, which is $1,000 per month from a small pension or a required minimum distribution from a modest 401k, and a single retiree with average Social Security crosses the threshold. Up to 85% of their benefit becomes taxable income. The formula designed for the wealthy is now reaching the median retiree. Let me show you what this looks like in specific dollar terms. A retired single woman collects $21,000 per year in Social Security. She also takes $15,000 per year from her IRA to cover living expenses. Her combined income calculation is $15,000 plus $10,500, which is 50% of her Social Security, for a total of $25,500. That is just over the first threshold. Up to 50% of her Social Security becomes taxable. That is $10,500 of income the IRS now counts as taxable that she had not planned for. Now take a retired couple. They collect a combined $36,000 in Social Security between the two of them. They take $24,000 per year in required minimum distributions from a 401k they built over 30 years. Their combined income calculation is $24,000 in distributions plus $18,000, which is 50% of their Social Security, for a total of $42,000. That exceeds the married couple threshold for the 50% bracket and approaches the $44,000 threshold for the 85% bracket. Up to 85% of their $36,000 benefit is now added to taxable income. That is $30,600 of Social Security income the IRS taxes at ordinary income rates. This couple did not think of themselves as affluent. They retired on what they thought was a moderate income. The 401k distributions alone would not have put them over the threshold. The Social Security income alone would not have put them over. It was the combination of both sources running through a formula frozen in 1983 that did it. Here is where the trap gets significantly worse for one specific group. When a spouse dies, the surviving partner loses the married filing jointly tax status. In the year after the death, they become a single filer. The single filer threshold for the 85% Social Security tax bracket is $34,000 in combined income. The married threshold is $44,000. That is a $10,000 gap. The surviving partner's Social Security benefit does not drop by half because their own benefit continues. Their combined income stays roughly the same, but the threshold dropped by $10,000. Income that cleared the married bracket now falls squarely in the maximum tax rate for a single filer. This is called the widow tax trap. It hits in the year after a spouse dies. At the moment of maximum financial disruption, the tax bill goes up. Nobody at the Social Security office mentions it. Nobody at the funeral home mentions it. The IRS sends a notice the following April. There is a family in Wisconsin. The husband worked 32 years in manufacturing. His wife worked part-time and raised 3 children. Together, they collected $34,000 per year in combined Social Security. He had a small pension of $14,000 per year. After he passed away in 2022, she continued to collect her own benefit of $11,000 per year, and she inherited his pension. Her combined income calculation as a single filer was $14,000 in pension plus $5,500, which is 50% of her $11,000 Social Security, for a total of $19,500. That kept her below the single filer threshold. But she also had a required minimum distribution of $9,000 per year from an inherited IRA left by her husband. That pushed her combined income to $28,500. More than 50% of her Social Security was now taxable. She had been paying no tax on Social Security for the 4 years she and her husband collected together. She found out about the widow trap when she filed her first individual return. Now let me address the specific income sources that feed the combined income calculation, because this is where families can still take action. Traditional 401k distributions count. Traditional IRA distributions count. Pension income counts. Wages, if you are still working, count. Capital gains count. Taxable interest and dividend income counts. Required minimum distributions from inherited retirement accounts count. Here is the important distinction. Roth IRA distributions do not count toward combined income. If your retirement savings are in a Roth account, withdrawals from that account are tax-free and do not appear in the combined income formula at all. You could take $50,000 out of a Roth IRA in a given year, and your Social Security taxation calculation would not move $1. This distinction is the basis for the only effective strategy available to most households. The window is called the gap years. The gap is the period between when you stop working and when Social Security benefits begin and when required minimum distributions begin. For people who retire in their early 60s and delay Social Security until 67 or 70, the gap can be 5 to 10 years. During those years, if your income is low, you may be in a 12 or 22% tax bracket. Those are the cheapest years in your financial life to convert traditional retirement account money into a Roth. A Roth conversion means you pay tax on the converted amount now at your current bracket. The money then sits in the Roth account, grows tax-free, and when you eventually withdraw it, those withdrawals do not count toward combined income. You have permanently moved that money outside the formula. Households that execute Roth conversions systematically during the gap years can reduce or eliminate the required minimum distribution problem and simultaneously reduce the amount of Social Security that gets taxed. Households that wait until the distributions are already hitting them have no good options. The money is in traditional accounts. The distributions are required by law. The combined income calculation is locked in. The second variable is the timing of the Social Security claim itself. Claiming at 62 produces a reduced benefit. Claiming at 70 produces a benefit that is roughly 76% larger. Many people delay claiming specifically to maximize the monthly payment, but a larger benefit means more Social Security income feeding into the combined income formula. For some households, delaying Social Security and drawing down traditional retirement accounts during the gap actually produces worse combined income outcomes in later years than a different sequence would have. There is no single correct answer. The math depends on the specific account balances, benefit amounts, and income sources for each household. What is consistent is that the sequence of income sources and the timing of each decision interacts with the frozen 1983 formula in ways that require specific analysis to navigate correctly. There is also a state-level dimension that catches households off guard. 11 states currently tax Social Security benefits at the state level in addition to the federal formula. Those states are Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Utah, and Vermont. Each state applies its own thresholds and phase-out rules. In some states, the thresholds are more generous than the federal formula. In others, they follow the same frozen structure. In Minnesota, the state formula can add several $1,000s per year in additional tax on top of the federal liability. If you live in one of these states and have not specifically reviewed how your state treats Social Security income, your combined tax exposure may be higher than your federal return alone reflects. The Greenspan Commission that recommended the original 1983 change produced a report that estimated the thresholds would remain relevant for years because inflation would be modest. That estimate was wrong. The Commission also did not recommend an inflation adjustment mechanism, which was an oversight that Congress never corrected. Multiple bills have been introduced over the decades to update the thresholds or eliminate the tax entirely for lower-income recipients. None have passed into law. The formula that was designed to tax the top 10% of Social Security recipients is now reaching more than 50%. The mechanism that caused that shift operates automatically. It does not require a vote. It does not generate a news story. The thresholds sit frozen and inflation does the rest every year. The families who pay the most in Social Security taxes are not necessarily the ones with the highest incomes. They are the ones with the most money in traditional retirement accounts that generate required minimum distributions, combined with Social Security benefits they spent decades earning. The combination runs through a formula written for a different economy and produces a tax bill most of them never saw coming. If you are between 55 and 65 and have a significant balance in a traditional 401k or IRA, the time to act is before the distributions begin. Find a fee-only fiduciary tax advisor this month. Ask them to model your combined income starting the year you claim Social Security. Ask specifically what percentage of your benefit will be taxable under current law, and ask how many years of Roth conversions you have available before the window closes. That conversation, done before the distributions start, is the difference between controlling the formula and being controlled by it. The IRS is not going to warn you. The Social Security Administration is not going to model this for you. The formula has been in place since 1983. The thresholds have not moved. What has moved is everyone else.